are increasingly tackling complex problems facing society in the form of environmental, social and governance commitments and practices. And we expect this trend to continue as events like the COVID-19 pandemic and climate change influence our capital markets. With the emergence of ESG in corporate reporting, it's important to keep in mind the basics of what ESG information is and why it matters in the first place. Many people associate ESG solely with climate change or a company's carbon footprint, but that's only one element under the ESG umbrella. ESG also includes broader information about a company's governance, ethics, and equal opportunity for employees. ESG stands for Environmental, Social and Governance Information. The E refers to environmental matters and is often the connection people make to ESG. It includes topics like water consumption, greenhouse gas emissions, energy consumption and waste. The S refers to social matters and examines how an organization manages relationships with employees, suppliers, customers, and the communities where it operates. Issues range from human rights to diversity and inclusion to other responsible business practices such as health and safety. Lastly, the G stands for governance, which deals with an organization's leadership and effective management of the business. Examples of governance considerations include executive pay, regulatory compliance, and shareholders' rights, as well as internal controls and internal and external audits. All of these subjects make up our ESG landscape, and it's important for companies to understand the risks and opportunities associated with these matters, how these might affect their business strategy, how the company plans to mitigate risks or capitalize on these opportunities, and then share relevant information with stakeholders. ESG information reported by a company needs to be credible and well supported for investors and other stakeholders to rely on for their decisions, which is where the public company auditor comes in. Public company auditors in their public interest role are key to the flow of reliable information for decision making. Like the audit of financial statements and internal control over financial reporting, third-party assurance from a public company audit firm enhances the reliability of ESG information presented by companies to investors and other stakeholders. Assurance on company-reported ESG information from a public company audit firm builds confidence among public company management, boards of directors, and stakeholders, and enhances the reliability of such information. Auditors conduct attestation engagements to obtain assurance that a subject matter is measured, evaluated, or presented in accordance with certain criteria. An ESG attestation engagement performed by a public company audit firm in accordance with the AICPA's attestation standards results in the issuance of an independent accountant's report that's designed to enhance the reliability of ESG information by expressing a conclusion or opinion on that information. Like the audit of financial statements, attestation engagements on ESG information by a public company auditor can provide an objective and impartial assessment of the assertions, data, and other disclosures made by management. Now that we've covered what ESG and ESG assurance are, it's time to answer one of the biggest questions when it comes to this kind of information. Why does ESG assurance matter? Investors are showing a significant interest in ESG information because this data can provide insight into a company's long-term value creation strategy and enables investors to better manage their investment risks and opportunities. As a result, the reliability of this information is essential. Leading companies like Starbucks, Coca-Cola, Nike, and Google are already receiving third-party assurance on their ESG information. These companies understand the importance of the data, and we can expect others to follow. The CAQ analyzed the most recently publicly available ESG data for S&P 500 companies and found that 95% of S&P 500 companies had detailed ESG information publicly available in a standalone ESG, sustainability, corporate responsibility, or similar report. The other 5% published some high-level policy information on their website. Further, we found that 264 of the S&P 500 companies assured certain of their ESG information. As current events continue to highlight the importance of managing ESG-related risks, we can expect the demand for assurance to continue growing as well. Public company auditors play a key role in providing trust and transparency in this information to maintain audit quality and keep our capital markets strong.